Welcome back to the deep dive. Tonight, well, the crypto world is absolutely buzzing, isn't it? All about WLFI.
Oh, definitely. It's huge. The Trump family project aspect alone means massive global attention.
Exactly. And you see it everywhere. People betting big on price, speculating, chasing the next hot token. It's chaotic.
It is. Classic launch frenzy.
But for you, listening in, we're asking, is there a way past just guessing? Is there a more certain, maybe strategic path to actually capitalize on all this excitement?
And the answer, well, we think it's a definite yes. It comes down to arbitrage.
Arbitrage. Okay, so let's define that first. What is it, really?
Right. So arbitrage, at its core, it's about exploiting these fleeting market inefficiencies. You're basically buying an asset where it's cheaper and selling it where it's more expensive simultaneously, like instantly.
So it's not about predicting the future price.
Not at all. It's about capturing those tiny differences that exist right now across different markets, different exchanges. And for something like WLFI, launching everywhere, high profile, these temporary gaps, they become more frequent, often bigger.
Okay, so that's what we're diving into today then. Specific, actionable stuff.
Precisely. We've looked at some really insightful analysis, and we're going to break down some very specific opportunities tied directly to WLFI.
And that's what we always try to do here. Give you that shortcut, get you well informed, pack it with hopefully some surprising facts, practical insights you can actually think about, a kind of strategic playbook for this WLFI launch.
Let's get into it.
All right, first up, the most straightforward kind, right? Exploiting price differences between different centralized exchanges, the CEXs.
Yeah, the classic CEX to CEX play.
It sounds simple on the surface, buy low on one, sell high on another, but what actually causes these price differences for a brand new coin like WLFI? It can't just be random.
No, it's definitely not random. It's a mix of factors. First, you've got the matching rules. How exchanges actually pair up buy and sell orders. Different platforms do it slightly differently, different priorities, and that can create tiny price variations.
Okay, matching rules. What else?
Then there are the opening times. This is a big one for launches. Not every exchange lists WLFI trading the exact same second. Even a few minutes difference can lead to significant price gaps right at the start.
Right, someone gets a head start.
Exactly. And beyond that, the order book density. How many buyers and sellers are there, and at what prices? On an exchange with a thin book, even small orders can push the price around quite a bit. More volatile.
That makes sense. Liquidity matters.
Hugely.
Yeah.
Then you have transaction fees. Seems obvious, but higher fees on one exchange can make its effective price slightly lower or suppress buying pressure.
And you mentioned something earlier, the deposit and withdrawal times. You said that was critical.
Absolutely critical, especially for a new token. The deposit and withdrawal schedules. Imagine an exchange opens trading for WLFI, but you can't actually withdraw your WLFI tokens for, say, 24 hours.
Ah, so the money can go in, but the tokens can't come out.
Precisely. It creates a one-way street for capital, for the tokens themselves. These inconsistencies, particularly in those first few volatile hours or days of a launch, that's fertile ground for arbitrage.
Okay, so that withdrawal schedule thing sounds key. And our sources actually highlighted a specific example with Binance, didn't they? That really illustrates this point.
Yes, the Binance scenario is almost a perfect textbook case. So WLFI spot trading, it opens tonight at 9 p.m. But crucially, withdrawals, they aren't enabled until 9 p.m. tomorrow night.
A full 24 hours later.
A full 24 hours. Now think about what that means. You can send your money to Binance, you could buy WLFI, you can sell WLFI on Binance, but you cannot move that WLFI off Binance to sell it somewhere else.
It's trapped there.
Trapped. So if there's strong initial buying demand on Binance, and with a launch this height, you might expect that the price there can easily get pushed higher than on other exchanges where tokens can move freely in and out. That single direction flow, that withdrawal lockup, it's a huge signal.
So the takeaway for you listening is check those deposit and withdrawal times first.
Always. It's often the biggest driver of these CEX to CEX gaps right at launch. If withdrawals are blocked on a major exchange, that's your flashing light for a potential premium there.
Okay, so we understand the why. Now the how. For someone actually wanting to do the CEX arbitrage, what's the practical setup? Is there a standard way to approach it? The source mentioned an arbitrage triangle.
Yeah, the arbitrage triangle is a good way to visualize the operational setup. You need three core components. First, your primary CEX. This is typically a big tier 1 exchange like Binance in our example. It's where you expect higher demand, more media focus, and potentially that higher price because of, say, withdrawal restrictions. This is where you plan to sell.
Okay, Binance is the sell point. What's next?
Second, you need a secondary CEX. This is a different exchange, crucially one that does allow immediate withdrawals for WLFI. And ideally, it has lower transaction fees to maximize your margin. This is where you plan to buy the cheaper WLFI.
Buy on the secondary, sell on the primary. Makes sense. What's the third point of the triangle?
The third point is your on-chain observation post. Think of something like the WLFI pool on Uniswap. Now, for this specific CEX arbitrage strategy, you're not trading here, but you're watching it. It gives you a real-time feel for the broader market pressure, the marginal buying strength coming from the decentralized side. It's like a background indicator.
Got it. So how do you actually execute? You're watching all three.
You're mainly focused on monitoring the order books and the recent trades, the transaction history, on both your primary CEX, Binance, and your secondary CEX simultaneously. You're looking for that price gap.
And what's the trigger? Just any difference?
No, it has to be significant enough to cover all your costs. You need Binance's price to be higher than the secondary CEX's price after you account for everything. That means subtracting the taker fees on both exchanges, the fee you pay for taking liquidity instantly.
Yeah.
You have to account for the bid-ask spread, and you have to estimate potential slippage, the risk that the price moves slightly against you between seeing it and executing the trade.
Right, slippage can eat your profit fast.
It really can. So once you see that clear net positive difference after all those costs, then the action has to be swift. You buy on the cheaper secondary exchange, and you immediately sell that same amount on the primary exchange, Binance. Speed is absolutely everything.
Yeah, you mentioned speed, and the source emphasizes this too. The main hurdle isn't figuring it out, it's the rhythm, the execution speed. It's a race against delays. What are these specific friction points?
This is where the rubber meets the road. Theory is one thing, practice is another. The deposit and withdrawal timings we talked about, they create the opportunity, but delays in moving your funds between exchanges can kill it just as quickly. An extra minute waiting for a deposit confirmation can mean the price gap disappears.
Okay, what else? System stuff.
Definitely. You might run into unexpected risk control pop-ups from the exchange system, asking for extra verification right when you need to click confirm. That adds seconds, which is huge. If you're moving funds on-chain, perhaps to position yourself, on-chain confirmation times are variable depending on network congestion.
And even clicking the button.
Even your own manual execution speed. How fast can you physically see the opportunity, calculate the profit, and click confirm on both trades? Milliseconds matter in these tight arbitrage scenarios.
Wow. So that potential profit range the source mentioned, 0.x% to 1.x% gross.
Yeah.
It sounds small, but I guess on large volume it adds up. But these friction points can wipe it out easily.
Easily. That's why the advice from the source is so crucial. Start small. Use a very small amount of capital first to walk through the entire process end to end. Time everything meticulously. How long does the deposit take? How long does the withdrawal actually take? What are the exact fees you paid? What was the slippage? Document every step, every cost.
It's like a dry run.
Exactly. Do that dry run. Understand all the real-world friction and costs. Only once you've done that, once you're confident in your timing and your cost calculations, only then should you consider scaling up to larger amounts. That due diligence, that discipline testing, it's paramount. Skip it. And you're likely to lose money even if you spot the price difference.
That's a really strong warning. So even with all that careful planning, doing the dry run, what's the biggest trap people still fall into when they try to scale up this CEX arbitrage?
I'd say it's overconfidence bleeding into ignoring liquidity. They get the small trades down perfectly, the timing feels right, then they scale up maybe 10x or 100x the capital without rechecking the order book depth at that larger size.
So their bigger order actually moves the price against them.
Precisely. Their buy order on the secondary CEX pushes the price up, and their sell order on the primary CEX pushes the price down. Suddenly, that 0.x% profit margin they calculated based on small trades vanishes, or even becomes a loss, because it had an impact when scaling.
That makes total sense. Okay, so assuming someone has mastered that rhythm, they understand the risks, they've done their homework, where do they look next for maybe more complex, more nuanced opportunities? Is there a level up from simple CEX to CEX? The source talks about triangular arbitrage as an upgrade. How is that different?
Yeah, triangular arbitrage, it definitely broadens the possibilities.
Mm.
What's intriguing here is that it often involves more intricate paths, including on-chain routes. You're not just stuck moving between two centralized exchanges.
So like CEX to DEX back to CEX, or across different blockchains.
Exactly. You might exploit a price difference by buying on a CEX, bridging the asset to a different blockchain, swapping it on a DX there, maybe bridging it back, and then selling out another CEX. Or it could even involve stablecoin swaps, maybe exploiting a tiny depeg between USDT and USDC on different platforms as part of the loop.
So more steps involved.
More steps, which means potentially more arbitrage opportunities because there are more places for prices to diverge temporarily. But every extra step, every different chain or DX you interact with adds another layer of complexity, another set of fees, another potential point of delay or failure. So yes, more opportunity, but also significantly more friction.
More friction, okay. Now the source mentioned a specific pattern often seen with multi-chain assets like WLFI early on, this sandwich price difference. Can you unpack that? What does that look like?
Right, this sandwich pattern is pretty common for tokens launching on multiple chains simultaneously. You'll often see prices on chains like BNB Chain or Solana tending to be a bit higher initially.
Why higher there?
Usually because they might have smaller initial liquidity pools compared to, say, Ethereum, and sometimes a higher concentration of trading bots that can quickly push prices up with relatively fewer orders. It's easier to pump the price on those chains initially.
Okay, so BNB and Solana might be the top layer of the sandwich. What's in the middle?
The middle might be Ethereum mainnet. Prices there often tend to be a bit lower. Why? Higher gas fees discourage lots of small trades, and sometimes fewer bots operate there because of the cost. Trading might be more conservative.
Got it. And the bottom layer?
The bottom layer frequently is the centralized exchange, CEX, spot price. CEX prices are often more controlled by designated market makers. Plus, they often have those deposit or withdrawal restrictions we discussed earlier, which prevents prices from equalizing quickly with the on-chain markets. So you get this structure, potentially higher on fast, cheap chains, lower on Ethereum, and often lowest on the restricted CEX. That's the sandwich. Understanding why these layers exist is key to potentially exploiting them.
That's a very clear picture. Now, given this extra complexity in triangular arbitrage multiple chains, maybe stablecoin swaps, are there other subtle factors that could sort of amplify the potential returns?
Yeah, potentially. The source specifically mentions the role of newer stablecoins, like maybe USD1. Now, we tend to think of stablecoins like USDT or USDC as being perfectly pegged at $1. But during volatile periods or on certain platforms, you can see tiny depegs. Maybe USD1 trades at 0.998 for a moment, or swapping it incurs slightly lower fees than swapping USDT.
Just fractions of a cent.
Exactly. But in an arbitrage loop, especially if you're moving significant capital, these tiny differences, a slight depeg here, a marginal fee advantage there can add up. They create these little extra profit margins that, when combined with the main price difference you're exploiting, can amplify the overall return of the entire arbitrage loop. It's about squeezing out every tiny edge.
This sounds incredibly intricate, though. Definitely not for beginners. The source seemed to issue a pretty strong warning here.
Oh, absolutely. This raises the crucial question. Who should even attempt this kind of complex triangular arbitrage? And the advice is clear. It's strongly cautioned against for novices.
Why specifically? Yeah. What knowledge is essential?
You need a really deep practical understanding of cross-chain mechanisms, how bridges work, their security, their speed. You need to map out the precise transaction paths across different chains and platforms. You need to intimately understand the impact of slippage on each DX you might use a large swap. It can drastically change the price you get. And you need a meticulous, almost obsessive grasp of all the associated fees. CEX fees, DX swap fees, bridge fees, network gas fees on multiple chains.
Wow, that's a lot to track.
It is. Without mastering all of that, the risks are just too high. You could get funds stuck on a bridge, lose a huge chunk to unexpected slippage, or find your entire potential profit completely eaten up by accumulated fees you didn't account for. The risk of error significantly outweighs the potential reward unless you are truly an expert in cross-chain operations. It's an advanced expert level play.
Okay, moving into even more advanced territory then. Let's talk about leveraging derivatives. Strategy number 3. Spot perpetual basis and funding rate arbitrage. Sounds very institutional.
It definitely is a core strategy for the pros. Market makers, market neutral hedge funds, quantitative traders. They have the scale, the low fees, and the cheap capital access to make it work really well.
Can retail traders do it though? Is it accessible?
Retail traders can attempt it, yes.
Yeah.
The mechanics are understandable, but honestly, they often operate at a disadvantage. Smaller capital usually means paying higher percentage fees on exchanges. Borrowing costs for capital might be higher. So that edge, that potential profit margin, is often less pronounced for an individual compared to a large fund. It requires significant capital and very efficient execution to be truly worthwhile.
Okay, understood. So diving into the mechanics, what are the fundamental ways you actually make money with this strategy? The source mentions two main sources of profit, or PAIL.
That's right, two primary profit streams. The first is the funding rate. Now, perpetual contracts, these futures that don't expire, have a mechanism to keep their price anchored close to the underlying spot price.
How does that work?
When the perpetual contract price trades higher than the spot price, the market is generally bullish. To balance this, the funding rate becomes positive. This means traders holding long positions, betting the price goes up, have to periodically pay an interest payment to those holding short positions, betting the price goes down.
Okay.
So the arbitrage strategy here is simple. You simultaneously go long spot plus short perpetual. You buy the actual WLFI tokens on the spot market, and at the same time, you short an equivalent dollar amount of the WLFI perpetual contract.
So your price risk is hedged.
Exactly. Your overall exposure to WLFI's price movement is essentially zero, or very close to it. But because you're holding the short perpetual position while the funding rate is positive, you collect those regular funding payments from the longs. It's like earning a steady interest income.
So you're basically getting paid for providing the liquidity or the balance that the market needs on the short side.
You've got it. You're getting paid for being on the less popular side of the perpetual market at that moment. Now, if the situation reverses, if the perpetual price is below spot, market is bearish, the funding rate turns negative. Now, shorts pay longs.
You flip the strategy.
Precisely. You then implement sell spot plus long perpetual. Sell your spot holdings, or short spot if you can borrow, and go long the perpetual contract. Again, your directional risk is hedged, but now you're collecting the negative funding rate paid by the short sellers. Either way, your net position is near zero directionally, and the funding rate acts like this periodic current account interest that captures the market's sentiment premium or discount.
Okay, that's the funding rate part. What's the second profit source? Basis regression.
Right, basis regression. The basis is simply the difference between the perpetual price and the spot price. Especially right at launch or during periods of extreme hype or panic, this basis can become quite large. The perpetual might trade at a significant premium, price much higher than spot, or a discount, price much lower.
Like a temporary disconnect.
Exactly. But markets tend towards efficiency. Over time, as market makers step in, as sentiment cools, this basis tends to shrink. The perpetual price naturally converges back towards the spot price or the index price it's supposed to track.
And the arbitrager profits from that convergence.
Yes, because they're already in that hedge structure.
Yeah.
Long spot plus short or vice versa. They automatically capture this price difference narrowing as a one-time profit when the basis shrinks on top of any funding rate they've been collecting. So the total potential profit is this combination of ongoing interest from funding plus a potential one-time gain from regression of the basis.
Interest plus regression. Sounds good, but what about costs?
Crucial point. You always have to subtract your costs. Any interest paid if you borrowed capital, transaction fees for setting up both legs of the trade, and potential slippage on execution. The net profit is what's left after all that.
It sounds powerful, but anything involving leverage and derivatives carries significant risk. What are the major pitfalls or complexities people need to be acutely aware of here?
Oh, absolutely. Yeah. Risks are significant. First and foremost, you must have a thorough understanding of liquidation mechanisms across different exchanges. How much can the price move against one leg of your hedge before you get margin called or liquidated? A liquidation breaks your hedge and can lead to catastrophic losses.
Okay, liquidation risk is number one. What else?
Slippage on entry and exit can erode those margins, especially if you're trading large size. Transaction fees add up. Knowing the exact funding rate settlement times is important. They usually happen every 8 hours, but timing can vary. And you need to be aware of trading depth. Trying to execute a large basis trade on an illiquid perpetual contract can move the price dramatically against you.
Any specific examples of when this went wrong?
The source specifically mentions the XPL short squeeze event as a cautionary tale. This was a situation where extreme buying pressure on a relatively thinly traded perpetual contract caused the price to spike massively, forcing liquidation even for traders who thought they were hedged against the spot price. It highlights how unexpected market dynamics, especially squeezes, can blow up even seemingly market-neutral strategies. You need robust risk management, probably using less leverage than you think you need.
That XPL example is definitely a chilling reminder, as you said, about market volatility. If there's one key lesson from that for someone attempting this strategy, what would it be?
Never, ever underestimate tail risk. Assume extreme moves can happen. Always maintain more than enough collateral. Understand the exact liquidation triggers for your positions on both the spot and perpetual side, and be prepared for scenarios where you might need to actively manage or exit the position quickly if one leg moves violently against you. Don't just set and forget.
Wise words. Now, are there ways this strategy is maybe packaged or automated? You mentioned high-yield vaults.
Yes, that's an interesting development. The source points to specific high annual yield vaults that essentially automate variations of this long spot plus short perpetual funding rate strategy for users. Examples mentioned include vaults from Stakestone and listed DAO.
And the yields were high.
Reportedly, after factoring in additional protocol subsidies or incentives, these vaults have offered APY's annual percentage yields exceeding 40%. So they handle the complexity of managing the hedge and collecting the funding rate, often boosting the returns with extra rewards. Of course, you then take on smart contract risk and platform risk instead of execution risk.
Okay, let's move to the next strategy. LP, liquidity provision, plus short hedge arbitrage. Now, you mentioned earlier, just providing liquidity on a day X isn't really arbitrage, right? It's more like market making with directional risk.
Exactly. Pure liquidity providing, LPing, is more about earning fees in exchange for taking on price risk, specifically impermanent loss. If the price of the token you're providing liquidity for moves significantly up or down, your LP position can end up being worth less than if you just held the original assets.
So how does adding a short hedge transform this into an arbitrage-like strategy?
What's fascinating here is that by layering on a precisely sized short hedge, usually using perpetual contracts, you effectively neutralize that directional price risk, including the impermanent loss component.
So you isolate the other factors.
Yes. The short hedge cancels out the price movement exposure. What you're left with is a net profit or loss curve derived purely from the transaction fees earned by your LP position, minus the cost of maintaining the hedge, which could be funding rate payments on the short perpetual or borrowing interest if you shorted spot, plus any rebalancing costs. You shift the focus entirely away from price prediction and onto fee generation.
Interesting. So how is this actually structured? What are the pieces you need to put together?
Typically, it involves two main components working in tandem. First, you have your on-chain liquidity provision. This usually means providing concentrated liquidity in a DEX pool, say for WLFI USDC, or maybe WLFI ETH. Concentrated liquidity means you specify a price range where your capital will be active.
So you're not providing liquidity across the entire price spectrum.
Correct. You focus your capital where you expect most trading to happen to maximize fee capture. The second component is your off-chain short position. You simultaneously take a short position of an equivalent nominal value, dollar value, of the WLFI exposure in your LP position. This is usually done with WLFI perpetuals on a centralized exchange.
And if perpetuals aren't available for WLFI yet?
The alternative, though usually less efficient due to higher costs or complexity, is to borrow WLFI tokens in a margin account on a CEX and then sell them, essentially creating a spot short position. But perpetuals are generally preferred for this hedge leg due to ease and often lower costs. The key is that the dollar value of your short hedge matches the dollar value of the WLFI in your LP position.
So just to be crystal clear, what's the fundamental goal here? What are you trying to achieve with this combined LP plus short structure?
The core objective is simple. It's not about betting whether WLFI's price will go up or down. You've neutralized that. Instead, your entire focus shifts to earning transaction fees from the trading activity, the swaps, happening within your concentrated LP range on the BEX.
So your LP position becomes like a toll booth.
That's a perfect analogy. Your capital acts as a toll booth. Every time someone swaps WLFI for a USDC or vice versa, using your liquidity within your set price range, you collect a small fee. The more trading volume that passes through your range, the more fees you collect, the thicker your earnings, as the source puts it. The short hedge is just there to protect you from price movements while your toll booth operates.
Okay, the toll booth analogy helps. Can you walk us through the execution steps then? Specifically, how do you set up that fee collecting market making range you mentioned for the LP part?
Sure. First, you need to select an appropriate fee tier and price range on the day X. For a new, likely volatile coin, like WLFI, you might choose a higher fee tier, maybe 0.3% or even 1%, as traders might be less price sensitive initially. Then you set a price range, maybe a medium width, around the current spot price. Too narrow, and the price might quickly move outside your range, stopping your fee collection. Too wide, and your capital efficiency drops.
So you need to actively manage that range.
Potentially, yes. After you deploy the LP position, it will will typically start with a mix of assets, maybe 50% WLFI and 50% USDC, depending on where the current price is relative to your range.
And then the hedge.
Then comes the critical hedging step. You look at the dollar value of the WLFI currently in your LP position. You then go to a CEX and open a short perpetual position for that exact same dollar amount. This ensures that, at least initially, the two legs are balanced and your net exposure to WLFI price changes is zero.
What happens as the price moves?
As the price fluctuates within your set LP range, two things happen. On-chain, your LP position earns fees from swaps. It also passively rebalances. As the price of WLFI goes up, it sells some WLFI for USDC. As it goes down, it buys WLFI with USDC. Off-chain, your short perpetual position gains or loses value, offsetting the price change impact on the WLFI held in your LP. This keeps your overall position close to market neutral.
And the funding rate on the short.
Right, that's the ongoing cost or potential income. If the funding rate for the WLFI perpetual is positive, longs paying shorts, your short hedge actually generates additional income. If the funding rate is negative, shorts paying longs, then it's a cost to your strategy. In that negative funding scenario, you'd need to be earning enough swap fees on the LP side to cover that cost. It might mean you need a wider LP range, lower leverage on your short, or less frequent rebalancing to maintain overall profitability.
Okay, that's quite a detailed process. How does this LP plus short hedge strategy really differ from, say, the basis arbitrage we talked about earlier, or just doing pure LPing?
Good question. Connecting it back helps clarify. If we compare it to basis arbitrage, basis are primarily profits from the price difference between the perpetual and spot markets converging, plus the funding rate. The profit source is that basis narrowing and the funding payments.
Here's LP plus short?
LP plus short primarily profits from the on-chain swap fees generated by trading volume within your LP range. The funding rate on the short hedge is a factor, either income or cost, but the main engine is the DEX fee generation.
And compared to just being an LP provider without the hedge?
The difference there is stark. Pure LPing is highly exposed to directional price movements and the risk of impermanent loss. Your profitability depends heavily on the price staying stable or moving in a way that benefits your pool ratio. The short hedge in the LP plus short strategy specifically mitigates that directional risk. It essentially removes the impermanent loss gamble, allowing you to focus purely on harvesting those transaction fees, making it much closer to a true market-neutral arbitrage strategy.
All right, let's shift gears again into some really niche, almost predictive types of opportunities. First one, WLFI crypto stock arbitrage involving ALTS. Okay, unpack this one for us. There's a publicly traded company involved, ALT5 Sigma.
Yes, this is a fascinating indirect play. ALT5 Sigma trading on NASDAQ under the ticker ALTS. According to the source, this company raised a significant amount of capital, around $1.5 billion, through stock offerings and private placements.
Okay, and how does WLFI fit in?
A portion of those funds was directly converted into WLFI tokens, and another part was used to buy WLFI on the secondary market. So the company holds a substantial amount of WLFI on its balance sheet. This effectively makes ALTS stock a kind of treasury or a proxy exposure to WLFI.
So holding ALTS stock is like indirectly holding WLFI?
To a large extent, yes. The company's valuation is significantly tied to the value of its WLFI holdings. People interested in this can find more details on ALTS in the related readings linked in our source.
Interesting structure. So what's the actual arbitrage logic here? The source describes it as short the stronger, long the weaker. How does that apply to ALTS and WLFI?
The core idea is that even though ALTS stock acts as a proxy for WLFI, their prices won't always move in perfect lockstep, especially in the short term. There can be temporary divergences. The strategy is to monitor the relative price performance of ALTS stock versus the WLFI token.
And
the principle is, if one is significantly outperforming the other relative to their typical correlation, you short the asset that appears stronger or overvalued in the pair, and you simultaneously long the asset that appears weaker or lagging. The bet is that this temporary price spread between the stock and the token will eventually narrow or revert to its historical mean.
You profit when they come back together.
Exactly. Once the assets revert to their expected correlation, you close both positions, capturing the profit from that convergence. It's a form of statistical arbitrage or pairs trading applied across the crypto and traditional equity markets.
Can you walk us through a specific scenario? How might this play out with WLFI and ALTS?
Sure. Let's imagine WLFI token experiences a sudden rapid price surge, maybe driven by hype around new CX listings or some big news. It's trading 247, so this could happen quickly.
Okay, WLFI pumps. What about ALTS?
ALTS stock, being a traditional equity traded on NASDAQ, might lag behind. Why? Well, the U.S. stock market has fixed trading hours, 9:30 a.m. to 4:00 p.m. EST, so it might not react immediately if the WLFI pump happens overnight. Also, borrowing costs to short ALTS stock might be higher or availability limited, slowing down arbitrageurs trying to short it. This creates a temporary widening gap where WLFI has run up, but ALTS hasn't caught up yet.
So the arbitrage opportunity arises then?
Yes. The opportunity crystallizes, for example, when the U.S. stock market opens the next day. Arbitrageurs or investors might then pile into ALTS stock, buying it to match its proxy exposure to the now higher WLFI price. This buying pressure on ALTS helps close that gap. An arbitrager who had gone long ALTS, the laggard, and short WLFI, the leader, would profit as this gap narrows.
In this scenario, do the funding rates from WLFI perpetuals matter much if you use those for the short leg?
If you use WLFI perpetuals to short WLFI as part of this pairs trade, you might indeed collect or pay funding rates incidentally. That could add a small positive or negative carry to the position. However, the primary driver of profit in this specific crypto stock arbitrage strategy isn't the funding rate. It's the price difference regression itself, that convergence between the lagging stock and the leading token. The funding rate is more of a secondary effect here.
Okay, so how does this crypto stock pairs trade fundamentally differ from the spot perpetual basis arbitrage we discussed earlier? Both seem to involve profiting from price convergence.
That's an important distinction to make. With spot perpetual basis arbitrage, there's a strong, almost certain anchor between the perpetual contract and its underlying spot asset. Due to the funding mechanism and the possibility of eventual delivery or cash settlement, they have to converge over time. The relationship is mathematically enforced.
But not between a stock and a token.
Exactly. There's no such guaranteed mathematical anchor between the price of ALTS stock and the price of the WLFI token. ALTS is treated more like a shadow or proxy representation of WLFI. The correlation is strong because of the company's holdings, but it's not absolute. It's much more similar to the older strategy some traders use with Bitcoin, BTC, and MicroStrategy MSTR stock. MSTR holds a lot of BTC, so their prices are correlated, but external factors can affect MSTR stock independently. It's a correlation trade, not a guaranteed convergence trade.
And I imagine trying to trade across two completely different market structures, 247 crypto and session-based stocks, must have practical challenges. What are the main difficulties?
Absolutely. The source highlights several key challenges. The first is just general friction. The operational complexity of setting up accounts, managing capital, and executing trades simultaneously across both crypto exchanges and traditional brokerage platforms. They operate differently.
What about timing?
Trading hours are a major issue. Crypto markets trade nonstop. NASDAQ has specific hours, plus pre-market and after-hours sessions with potentially lower liquidity. WLFI unlocks, according to the source, around 8 p.m., presumably local time in context, which means significant WLFI price action could happen before the U.S. stock market even opens at 9:30 a.m. EST the next day. That timing mismatch creates risk.
Pre-market trading exists, but it's different.
Yes, pre-market trading is possible for stocks like ALTS, but it usually has wider spreads and lower volume, making it harder to execute large arbitrage trades efficiently. And finally, there's the risk of halts. Stock trading can be halted due to volatility, circuit breakers, or specific news. If ALTS trading gets halted while WLFI continues to trade wildly, one leg of your arbitrage position is frozen, leaving you completely exposed on the other leg. That's significant risk.
Right, definitely a niche and complex strategy. Let's switch gears one last time to something completely different. Prediction markets. Okay, let's unpack this polymarket WLFI market cap bets arbitrage. What's being offered there?
All right, this is really interesting because it's not about trading the asset directly, but betting on its future valuation. On Polymarket, the source identifies two distinct types of betting markets related to WLFI's fully diluted valuation, FDV, one day after its launch.
Two types, what are they?
First, there's a tiered market. This is a multi-option bet where you choose which range WLFI's FDV will fall into. For example, the options might be less than $10 billion, $10, $12 billion, $12, $14 billion, $14, $16 billion, or greater than $16 billion. You pick one out of five.
Okay, like a multiple choice question. What's the second type?
The second is a threshold market. These are simpler binary yes-no questions. For instance, there might be separate markets asking, will WLFI's FDV be above $13 billion? Yes, no. Will it be above $35 billion? Yes, no. So you have these bracket bets and these over-under bets, all referencing the same underlying event, WLFI's FDV, one day post-launch.
So multiple ways to bet on the same outcome. What's the underlying principle here that actually allows for arbitrage? It seems like pure speculation.
But what's fascinating is the hidden mathematical structure. Because all these different markets, the tiered one and the various threshold ones, are asking about the exact same future event, their implied probabilities must be mathematically consistent with each other. If they aren't, there is an arbitrage opportunity.
How so? What are the consistency rules?
There are a few key rules based on basic probability. First, within the tiered market, the sum of the probabilities, represented by the prices of the contracts, which range from $0 to $1, for all 5 possible outcomes must equal 100%, or $1. If you can buy contracts representing all possible outcomes for less than $1 total, or sell them for more than $1 total, that's an arbitrage.
Okay. Probabilities must sum to 1. What else?
Second, there needs to be consistency between the market types. For example, the price of the $16 BF contract in the tiered market must logically equal the probability implied by the $16 threshold market, if one exists with that exact threshold. They are betting on the same thing.
Right, they should match.
And third, relatedly, the sum of the prices of all the complementary tiers in the tiered market, i.e. all tiers below $16B, must equal 1 minus the probability of $16B derived from the threshold market. If P16B is $0.30, then the sum of P10B, P1012B, P1214B, and P1416B must equal 0.7 cents. If these mathematical relationships don't hold across the different markets, the probabilities are inconsistent.
That's incredibly clear. The market is essentially contradicting itself. So how can you, the listener, actually exploit these inconsistencies on Polymarket to lock in a profit?
You directly trade against the inconsistency. Let's take scenario 1, overvaluation. Suppose you notice that the probabilities implied by the market prices add up to more than 1. For example, maybe the $16 base contract in the tiered market is priced high, but the sum of the other 4 tiers, representing $16, is also high, making the total cost to cover all outcomes greater than $1.
So buying everything costs more than the guaranteed payout.
Exactly. In this case, the market is overvalued. The arbitrage is to effectively sell this overpriced basket. You could sell the individual overvalued contracts or use no bets in the threshold markets to synthetically create the position. Your goal is to construct a portfolio of bets that guarantees you receive $1 regardless of the outcome, but your net cost to enter the position, or net credit received, is better than paying $1. You're essentially selling a guaranteed $1 payout for more than $1.
Okay, that's overvaluation. What about the opposite?
Scenario 2, undervaluation. This is simpler. If you find that the implied probabilities add up to less than $1, meaning you can buy contracts representing all possible outcomes for a total cost of less than $1, say $0.954, then the market is undervalued.
So you just buy everything.
You simply buy the complete set of contracts covering all possibilities across the inconsistent markets. Since one of the outcomes must occur, one of your contracts will pay out $1. Because you acquired the full set for less than $1, you've locked in a guaranteed risk-free profit equal to the difference, $1 your cost. It's a pure play on mathematical inconsistency.
That is genuinely intriguing. Why is this particular strategy so interesting, even though it's happening in what feels like a purely speculative prediction market? What's the bigger takeaway?
What's truly fascinating about this, I think, is that it demonstrates how arbitrage principles, finding and exploiting pricing inconsistencies, can apply even in markets that seem based purely on opinion or speculation. It reveals these fundamental mathematical seams that can exist in any pricing system, whether it's for stocks, crypto, or bets on future events.
So it's about critical thinking.
Exactly. It really underscores the importance of rigorous critical thinking, understanding probability, and looking for the underlying logic, or lack thereof, in how markets price related outcomes. It's a powerful example of how applying basic mathematical consistency rules can turn even seemingly speculative events into potentially calculable lower risk opportunities. It teaches you to look beyond the surface narrative of the bet and analyze the structural integrity of the market's pricing itself.
Wow. What an incredible journey we've taken tonight. Seriously, from the basics of CEX price differences and that intricate dance of triangular arbitrage, then into the really sophisticated world of spot perpetual basis and funding rate strategies, and that clever LP plus short hedge approach.
Yeah, covering a lot of ground.
And we wrapped up with these truly unique angles, the WLFI crypto stock arbitrage with ALTS, and just now, the almost mathematical puzzle of the Polymarket prediction bets. We've really covered a huge range, a deep dive for sure.
We certainly have. And I think the crucial thing to keep hammering home is that while all these strategies offer potentially compelling ways to profit from the WLFI launch, none of them are easy money. Success absolutely hinges on meticulous execution, a really deep understanding of all the market mechanics involved, and a sharp eye for detail.
And timing.
In timing, definitely. These are often advanced strategies targeting specific, often very fleeting market conditions. Understanding those friction points we talked about, the fees, the delays, the slippage, the liquidation risk, that's absolutely essential to actually turn a potential gross profit on paper into net profit in your account.
Absolutely crucial distinction. So for you listening, as we wrap up, what really stood out from all of this? Did one strategy kind of pique your interest more than others? Or maybe it reminded you of similar opportunities you've seen or thought about before? It's definitely worth reflecting on these different angles.
And maybe, if we connect this to the bigger picture one last time, the real lasting takeaway here extends far beyond just WLFI or even crypto itself. It's about truly understanding these fundamental market mechanics, learning to spot these seams in the financial fabric, these places where inefficiencies or inconsistencies create opportunities. That skill equips you with a lifelong lens for identifying potential value.
Not just in crypto, then.
Not at all. It's about learning to see the underlying system, the structure, rather than just reacting to the noise of individual asset prices. This kind of critical thinking, this search for discrepancies for arbitrage in the broadest sense, it's applicable everywhere. Traditional finance, commodities, prediction markets, maybe even in completely different industries where resources or information are priced inefficiently. The ability to spot and rationally capitalize on those moments is an incredibly powerful skill to cultivate.
That is a truly profound thought to end on. Seeing the system, not just the assets. Love that. Well, thank you so much for joining us on this deep dive today. Keep that inquisitive mind working, keep exploring, and stay informed.
Always keep learning.
Until next time.